All right, let's talk about something that catches a lot of foreign companies in Japan off guard, a hidden tax risk that can lead to some seriously unexpected bills. Now, it's not super complicated, but it's incredibly easy to stumble into if you don't know it's there. So, we're going to break down exactly what this is all about.
Okay, let me ask you a question, and this gets right to the heart of it. Is your Japanese subsidiary ever providing services or support to your parent company overseas? Maybe even a sister company, but doesn't send an invoice? It seems totally normal, right? Just part of being a big global family.
Well, that exact situation, the Japanese sub providing a service and the overseas parent not paying for it, that is exactly where the trouble starts. That simple, everyday act can actually trigger a pretty big tax bill in Japan, a non-deductible one. So, how on earth does that happen? It all comes down to how Japanese tax law defines one little word.
And that word is donation. Now, I know what you're thinking. A donation is when you give money to charity, right? Well, in the world of Japanese corporate tax, the definition is way, way broader than that. It casts a surprisingly wide net. Let's actually look at the official definition here. A donation, or kifukin in Japanese, is a gift or any kind of provision of money, assets, or, and this is the important part, any economic benefit without getting fair compensation in return. The two phrases to really lock onto are any economic benefit and without fair compensation. All of a sudden, you realize this has nothing to do with nonprofits. It's about any one-way transfer of value. So the real trick is understanding the line between what the tax office calls a legitimate business expense and what they call a donation. Think of it this way. A business expense is something you do expecting to get something back. You run an ad, you hope for more sales. Simple. But a donation, that's when you give away value with no direct return expected, and that is exactly where things like providing free services to your parent company get snagged. Okay, so we've defined what a donation is in this context. Now, we've got to talk about how they're actually treated for tax purposes. Because, you see, in Japan, not all donations are created equal. The rules get really specific really fast. This table breaks it down pretty clearly. Give a donation to the government? Great, that's 100% deductible. Give to certain public interest groups? Okay, there are some special limits, but I want you to look all the way down at that last row. If you're a multinational company, this is the one that should make your ears perk up. Yep, you're reading that right. Any economic benefit, we're talking unpaid services, uncollected fees, you name it, that flows from your Japanese subsidiary to an overseas parent or sister company is considered a 100% non-deductible donation. The deductible amount isn't just limited, it's zero, zilch. That means the cost of providing that service, you can't use it to reduce your taxable income at all. And this, my friends, leads us straight into what I call the intercompany transaction trap. We're going to connect the dots now between this broad definition of a donation and the day-to-day operations of your business. This is where we get into things like deemed donations and how it relates to transfer pricing. So, what does this look like in the real world? Let's run through some classic scenarios. Imagine your Japanese sub sends an engineer to help out a sister company in another country for a week, but you never send an invoice for their time. Or maybe your Japan office acts as a regional hub and pays for a big ad campaign that benefits the whole group. And here's a really common one. You just decide to waive the management fees you're supposed to collect from your parent company because, hey, they had a tough year. To you, that's just helping out the family. To the Japanese tax office, these are all deemed donations. Now, a lot of you are probably thinking, isn't this just transfer pricing? And that's a great question, but it's super important to understand that this is a totally separate risk. With a deemed donation, the big problem is that no payment happened, zero. So the entire cost of that service gets disallowed. With transfer pricing, or TP, the problem is that the wrong price was charged, so the tax office just adjusts the price and taxes you on the difference. The deemed donation rule is often a much simpler and, frankly, harsher tool for them to use. So you might be wondering, why would the tax authorities even bother with this rule when they have transfer pricing? Well, think about it. It's just easier for them. They don't have to go through super complex analysis to calculate a fair arm's length price. All they have to do is prove one simple thing. A benefit was provided, and nobody paid for it. For small and medium-sized companies in particular, this is a much more common way to get challenged than a full-blown TP audit. All right, so after hearing all that, the big question is obvious. How do you stay out of this trap? The good news is you absolutely can. With the right processes and good documentation, you can seriously reduce your risk. The whole game is about treating your related companies as if they were any other third-party customer. It really boils down to a simple 3-step process. Step 1, formalize everything. You need clear written service agreements for any and all support that's provided between your group companies. Step 2, charge for it. Make sure every intercompany service is billed at a fair arm's-length price. And finally, step 3, document and collect. Send those invoices out on time and keep really good records of all your transactions and payments. This is your proof. This is how you show the tax authorities that this was a real business deal, not a hidden donation. Okay, we've covered a lot of ground here, so let's just boil it all down and summarize the most important things you need to remember. First off, in Japan, the word donation is huge. It means any economic benefit you provide without getting fair payment back. Second, and this is the big one, any value your Japanese sub gives to an overseas-related company for free is a fully non-deductible donation. Third, remember that this deemed donation risk is a separate beast from transfer pricing. And finally, your best defense is just being diligent. Formal agreements, fair prices, and proper invoicing. That's how you prove you're running a business, not a charity. So, I'll just leave you with this one question to think about for your own company. Are your intercompany agreements strong enough to stand up to scrutiny from the Japanese tax office? Can you actually prove you're conducting business and not just giving away value for free? Because when you're dealing with Japanese tax, that little distinction can make all the difference in the world. Thanks for tuning in.